Ron, keeping with the tax issues, let's talk a little bit about home equity lines and
Okay.
the tax consequences around residential or investment property with an equity line.
Okay. The important thing to remember is that you can have acquisition debt, home equity debt. So acquisition debt is a debt incurred to build, acquire, or improve residential property. And the definition of debt that is not acquisition debt is really, really complicated. The IRS says it's everything else. So that kind of says, okay, I'm very limited to what is considered acquisition debt and home equity debt. Home equity debt would be, obviously, if you had a house and you wanted to do an addition, you might go to the bank and draw on your equity. And you might get a $200,000 home equity line. Under the old rules, all you had to do was have the home equity line secured by your residence, and you could deduct the interest in your personal tax return. Under the new tax rules, that is the only way you can deduct it. So I have a client that just had a house with $2 million of equity in it, took out a home equity line for $1 million to start a business. And they spent the $1 million over the course of a year developing this business. The interest expense in that home equity line is not deductible because it was not incurred with their original house in mind. It was not used to improve the house. It was used for a completely different purpose. So the old days where you could take a home equity line against your equity in your home and take a trip to Bermuda, or use the money for college tuition, or buy a new RV or whatever you want to do with it, and deduct interest in your personal return, those days are gone.
Such a helpful bit of information for everybody. Thanks, Ron.
You're welcome.